A very warm welcome to today's session on corporate governance and transition, as you see there. So we will be sharing the Indian and the Japanese experiences and how compare and contrast these experiences. So this event is jointly sponsored by Mizuho India Japan Study Center, or MIJSC as we call it, and Center of Corporate Governance and Sustainability, CCGS as we call it at IIM Bangalore. MIJSC was set up as a center of excellence at IIM to serve as a facilitator for many collaborative initiatives between academia, industry, policymakers of both India and Japan, which are of mutual interest. And Professor Jaideep Sarkar is the chairperson of this COE. CCGS serves as a platform to connect both the academics and the practitioners for a discussion on both the current and emerging trends in the field of corporate governance and sustainability practices. It is recognized by the National Center for Excellence. This is by the National Foundation for Corporate Governance, which is part of the Ministry of Corporate Affairs, Government of India. Professor Padmini Srinivasan is the chairperson of this center. So today we have a lot of people who have joined online as well. And we have here some people who have joined us for a physical interactions, and I'm thankful to both of you. These two centers of excellence have come together to host this very exciting and I would say very topical seminar. And we have tried to bring in academics from both India and Japan, as well as industry people, as you will see here. To just quickly to set the context for why we chose this, because the light of the increasing global focus on corporate accountability, transparency, as well as ethical practices, corporate governance has become a subject of great importance to not only the corporates, but also to Aam Aadmi like us. In both the countries, both India and Japan, corporate governance reforms have evolved in response to the changing economic, changing regulatory, cultural, as well as the business landscapes of these two countries. Today, we will try and explore how these two countries have navigated their governance frameworks with distinct yet impactful approaches to bring in those 4 or 5 dimensions that we talked about, focusing on key issues of regulatory reforms, ESG initiatives, stewardship codes, shareholder value, cross-shareholding challenges of especially in Japan, but also in India. I am honored to introduce our esteemed panelists for this discussion, and each brings a wealth of experience and expertise in this field. First, let me extend a very special welcome to the Professor Fumiko Takeda, who is a distinguished visitor to MIJSC this week. Professor Takeda is a very renowned scholar in Japan and globally. She works in Keio Business School in Japan, and she specializes in corporate governance, shareholder activism, which is her current area of research, and institutional investor behavior. Prior to joining Keio, she spent many decades at Tokyo University, which is the premier university in Japan. And her extensive research focuses on, as I said, shareholder proposals, corporate disclosures, and their impact on market value and governance specifically. We are indeed very privileged to have her with us today, and she will be sharing her insights into Japan's evolving corporate governance practices. Next, I would like to, of course, Professor Padmini Srinivasan is a very well-known figure. And apart from being the chairperson of the Center of Corporate Governance and Sustainability, he is a professor of finance and accounting at IIM Bangalore. Professor Srinivasan's extensive experience in teaching, research, but also in consultancy brings in, especially in areas of corporate governance, financial reporting, makes her actually the perfect guide for this discussion. Thank you, ma'am. She brings both academic rigor as well as practical experience in this conversation. She will be a speaker as well as a moderator for today's seminar. As a speaker, she will compare and contrast the Indian approach versus the Japanese approach, which will distill many valuable learnings for all of us today. We look forward to a vibrant exchange of ideas today, as well as we'll be able to dive deep, hopefully, into the challenges and opportunities in corporate governance reforms in India and Japan. Thank you all for joining, both virtually as well as physically. And now may I hand over the floor. Sorry? Yes, yes. Oh, sorry. My apologies, Kripa.
No problem.
So we would like to acknowledge the fact that Mr. J.N. Gupta, a towering figure in the corporate governance space in India, he could not join us today due to some health issues at the last minute, but we are very fortunate that we have with us Ms. Kripa Hegde, who will represent the Shareholders Empowerment Services, or SCS, in his place. Ms. Hegde is a research analyst at SCS, specializing in proxy advisory guidelines, and has been with this organization for the past 4+ years. She has started her career as a management trainee at Tata Steels, where she had honed her skills in the area of corporate governance. Ms. Hegde is a company secretary and is deeply committed to guiding and for empowering stakeholders through her deep work in this field. We are indeed very excited to have her share her insights on this very topical and very interesting subject, especially from a young professional's perspective. Thank you, Kripa. So, hand over to Professor Takeda. Would you like to come and share your thoughts?
Thank you so much. That's a nice introduction. It is my great pleasure. Thank you. To talk about corporate governance in Japan, which is in transition here. So first of all, I'd like to give you the overview of Japan's corporate governance and what happened and is happening currently. So traditionally, the Japanese corporate governance system has classified as a stakeholder governance system, which is opposite to shareholder governance system. And this system is typically characterized by debt financing, cross-shareholdings, and interconnected networks among affiliated companies, trading partners, and the main banks. So we call this keiretsu in Japanese. And in the system, the main banks are the center of the system. And the banks have private information on their debtors, and they tend to provide monitoring and insurance services and solve agency problems by mitigating information asymmetry. However, the situation has been changed after the collapse of the bubble economy in early 1990s. So the collapse of the bubble forced Japanese companies to drastically change their corporate governance, which led to a decrease in cross-shareholdings, an increase in the ratio of foreign shareholders, and a more transparent selection of external board members and CEOs. And as cross-shareholdings gradually dissolved, shareholder activism attracted attention through its hostile approach to management. So this graph shows cross-shareholding ratio in Japan since the end of the World War II and to 2021. So this ratio peaked out at around the beginning of 1990s, and it reached more than 50%. However, after the collapse of the bubble, the ratio declined dramatically and currently around 10%. So before that, these practices among affiliated companies have prevented shareholders from exercising voting rights. So this continued until the first wave activism started in the early 2000s. And so this graph shows shareholder composition. So alongside with decline of cross-shareholdings, the share of commercial banks, main bank, including main banks and other banks, and the insurance companies declined. Instead, the share of foreign investors increased. And usually, we regard foreign investors and trust banks as institutional investors, and banks, insurance companies, and business corporations are regarded as stable or affiliated shareholders. So combining these things, the next graph shows more clearly the contrast between institutional investors and stable shareholders. And these ratio, they changed around 2000. And currently, we experienced waves of activism. So the first wave of activism occurred in the first half of 2000. And Japan's first proxy fight was done by Mr. Murakami, the famous hedge fund activist. And this fund conducted hostile TOB for company Shoei in 2000. And this is a picture of Murakami and his daughter. Both are very famous activists in Japan. And hedge fund activists tended to hold a large amount of shares, and to realize proposals for larger shareholder returns, including increase of dividend payouts and share buybacks. And at that time, hedge funds activists are called vultures because of their intense conflict with managers. And the first wave of the activism almost ended at around 2008, the period of global financial crisis. However, the activism regained momentum around the mid-2010s. So at that time, under the Abe administration, the Cabinet Office approved the Japan Revitalization Strategy in 2013. And following this strategy, the two codes, so-called two codes, were enacted. The first one was the Stewardship Code in 2014. The second one is Corporate Governance Code in 2015. And by these two codes, the responsibilities of institutional investors have been highlighted. So they were required to fill the gap brought by the decline of the bank's status. So here is a brief overview of the Stewardship Code in 2014. This code sets forth the principles for institutional investors to fulfill their fiduciary responsibilities, including encouraging medium to long-term corporate growth through dialogue. In particular, this code expects institutional investors to develop and publish clear investment policies and identify and manage their conflicts of interest. It calls for active dialogue between investee companies and investors, and a better understanding of circumstances surrounding investee companies is expected to change investors' exercise of voting rights. The second corporate governance code was enacted in 2015, and this code consists of 5 general principles listed companies can reference as guidelines for corporate governance. The first principle advocates the protection of minority shareholders and foreign shareholders. The fourth principle advocates the supervision of management and directors from independent and objective standpoint. And the fifth principle advocates constructive dialogue with shareholders beyond the general meetings of shareholders for creating sustainable growth and increasing the firm's value over the medium to long run. And these two codes are not compulsory. So the companies, Japanese companies, maybe choose to comply, or if not, they need to explain, like UK. So as I said before, in the first wave of activism, activist funds increased short-term shareholder returns, like increasing the dividends and share buybacks. However, after these two goals, in the second wave of activism, activist funds themselves tend to make proposals to increase shareholder value over the medium to long term. The changes caused by activists need to obtain approval from other shareholders. So in some cases, institutional and individual investors agree with activist fund proposals when activist demands capture the concerns of other institutional investors. And in particular, passive institutional investors began heeding external expert shareholder proposals and recommendations to reduce the large practical burden of analyzing all companies in detail. So the importance of proxy advisory companies has been increased in these years. This graph shows the number of activist funds in Japan from the mid-2010s. So the figure in this year is just by the end of July, but the number is already exceeded the previous years. So aside from Western activists and domestic activists, Asian activists from Singapore and Hong Kong also increased. And the next graph shows the number of shareholder proposals by activist funds. The popular topics consist of balance sheet issues, and also corporate governance issues are popular. And the other ones are environment and society, business strategy and management, and also election or dismissal of executives. Sometimes proposed by shareholders. And the next graph shows the number of companies receiving shareholder proposals. So again, concerning this year, already by June, the number exceeded the previous year. And so the institutional investor responsibility has been strengthened by two codes. And in addition, individual investors recently also tend to exercise their voting rights. So this graph shows the number of individuals who exercised the voting rights and those who did not exercise voting rights. And around 2010s, so we can see the reverse of the pattern, and so the number of individuals exercising voting rights increased increased from 50% to, in recent years, more than 70%. So this concise table shows the brief consequences of governance reforms in Japan. In the middle column, this shows the situation before two codes, and the right column shows the present situation. So if we look at the percentage of companies with outside directors, so before the two codes, only 9.9% companies have more than three outside directors. However, currently, 98.1% of companies have more than 1/3 outside directors. And concerning relational shareholding ratio, so before the two codes, so on the average percentage was 40%, but currently it reduced a little bit and to 30%. And the amount of shareholder returns, including dividend and share buybacks, this amount doubled, increased more than double comparing two periods. And the number of firms with anti-takeover measures have reduced after the two codes. And the number of publicly listed parent and subsidiary pairs have also reduced more than half. And the shareholder meeting concentration ratio, which is a percentage of companies holding meeting on the same day, reduced from 50% to around 30%. Previously, a lot of Japanese companies held a shareholder meeting at the same time. So the many shareholders could not attend several meetings at once. However, such concentration have been resolved in recent years. However, the researchers said operating performance, if you look at the operating performance, these measures did not show improvement. So ROE did not increase, and also cash and deposits increased. So this the many institutional investors blame Japanese companies of this issue. So they didn't efficiently use their money. Okay. So, and yeah, I didn't include this issue in the table. However, I think, yeah, several people may be interested in gender diversity. And in Japan's case, there is no requirements. So, but proxy advisory companies such as Grassroots recommended recommends a minimum ratio of the female directors, and they recommend more than 10%, and they try to increase the number in the future. So, however, if we look at the female directors ratio, last year it was just a little more than 10% for all listed companies. And if we look at the firms including Topics 100, it's less than 20%. So the number is much lower compared to other countries, G7 countries and OECD countries. And as I said before, this graph shows cash and deposit. So Japanese companies tended to accumulate cash and deposits. And if we look at the R&D, Japan's level was not so low. It's close to 10%. However, other so the countries in the US, Europe, and the Asia Pacific countries have higher ROE compared to Japan. So far, I just explained what has been, what has occurred in Japan. And from now on, I'd like to talk a little about the effects of activism. So because America is the largest market for activists, there are plenty of research papers on activism in the US. And the previous studies in the US show hedge fund activism can influence corporate management and board more effectively than other types of institutional investors, such as mutual funds and pension funds. And then hedge fund activists can gain this advantage through their greater incentives, larger unregulated pools of cash to invest in undiversified portfolios using leverage and derivatives, and fewer conflicts of interest compared to other types of investors. And the researchers using US data find positive abnormal returns or excess returns around the time that the hedge fund announces its activist intentions. However, evidence outside the US has little evidence, actually. And currently, actually, Japan is the second largest market for hedge fund activists. But yeah, the studies on Japan has not been so accumulated. And this paper, written by Betchto et al., yeah, they conducted a multi-country analysis, and they perform a broader study of 1,740 activist engagement for 2000 to 2010 across 23 countries. And their study includes 184 interventions occurred in Japan. And however, they report Japan generates different results from other countries by showing high initial returns, but insignificant long-run returns. And so far, the 6 studies examine the causes and the effect of activist funds in the Japanese stock markets. However, all of them studied focus mainly on the first wave of activism. So in recent years, I conducted several empirical studies to measure the effect of second wave of activism. And so the first two papers focus on the effect of large-scale shareholding, and the third one focuses on shareholder proposals, and the fourth and the fifth ones focus on proxy advisory, effect of proxy advisory firms' recommendations, and the last one picks up activist board representation. And concerning large-scale shareholding, and so this indicates acquisition of 5% shares or more. And in Japan, so if company acquire more than 5% shares, they have to report. So like timely disclosure. And because time is limited, this table shows a summary of my studies. Concerning the effect of large shareholdings and shareholder proposals, so the Japanese stock market show positive reactions to announcement of large-scale shareholdings and the announcement of shareholder proposals, basically. And market showed negative reaction to the rejection of shareholder proposals. So this means that basically investors welcome activist proposals or activist interventions. And also, when we consider the effect of proxy advisor companies' recommendations, we found dissenting recommendations of the proxy advisory companies reduce the approval rate of proposals. And also we find institutional investors' voting behavior is more consistent with the recommendations of proxy advisory companies than that of other investors. However, if we look at the operating performance, so we see we find the increase in shareholder returns, especially dividend payouts. However, operating performance, such as ROA, actually decreased. So this indicates that the short-termism is still observed in the second wave of activism. So, however, in the last paper, I picked up activist board representation. So this means that the activists send some outside directors in the board. So in such a case, activists themselves should be more responsible or more show more commitment or engagement with long-term issues. So, and actually, I found an improvement in the ROE and ROA of target companies listed after activist board representation. And actually, several companies show the improvement. However, this is not the end of the story. And actually, for some companies, especially the companies accepted board representation, activist board representation in earlier years, I found no improvement in the ROE and ROA for the target companies. And actually, these companies chose to be delisted after the intervention. Okay, so that's all I prepared for today's panel. So thank you so much.
Thank you. Thank you so much, Professor Takeda. Yeah. So the way we will go about is I will talk about Indian corporate governance and contrast how we are a little different from the Japanese corporate governance. And the second part of her presentation, which deals with shareholder activism, etc., I will ask Krupa to, because she's coming from a company which deals with all these shareholder activism, and also they are part of the proxy firm advisory. Therefore, she will bring in a perspective which is useful for us to understand how activism works in India and so on. Very quickly, to talk about corporate governance in India, I think the fundamental part of any good corporate governance or corporate governance is fundamentally it deals with agency problem. So agency problem typically deals with how do we ensure that the management acts in the best interest of all the stakeholders, or primarily the shareholders, but also all the stakeholders related to that organization and so on. So that is the crux of the corporate governance problem, which basically deals with agency problem. Now, how do you ensure agents act in the best interest of the principals? Now, traditionally, if you look at this model, you always think about US model, where you have the shareholders who are dispersed ownership, and you now look at the agents who are the who are more managerial in nature, in the sense they are professional managers and so on. So typically, how do you ensure that management will act in the best interest of those absentee shareholders who are not in business? So this corporate governance whole discourse and debate started in the US with this background in perspective. Now, while US and UK and few other countries follow this method, uh, primarily in India and most parts of the world, we don't have this problem. We don't have agency, principal agency problem so structured. We have principal agent problem, which is principal who is a shareholder is also managing the business. So in the sense, it's no question of asking how that agent will manage in the best interest of the shareholder. It's rather how the agent now, who is also a principal, will act in the best interest of the minority shareholders. Those absentee shareholders who are not there. So this is the crux of a problem in most parts of the world, where corporates are governed by business groups, they are governed by family businesses and so on. And therefore, the nature of our problem is very, very different from the nature of problem that we have in Japan and others. And therefore, while we look at solutions for each of these, some of the solutions will work, for example, in Japan, but some of these solutions will not work in India, because the context is very different. So very quickly, to go about corporate governance development in India with this background, somewhere in 1956, the first Corporate Companies Act was formed, and that is where it started with understanding about governance and what are the legislations we should have and so on. It was one of those large, voluminous piece of regulation in Asia. It was the largest one in Asia. Then, of course, reform started, economic reform started in 1991. With that, with the opening up of the economy, came a lot of other issues as well. And then in 1998, CII, came with this desirable corporate governance code. And that code, set the tone for future corporate governance in India. What should be the kind of regulation we should have, and so on. And various task forces over the years have been formed by the regulators. So starting with Kumar Mangalam Birla Committee, and therefore he came out with a set of requirements for corporate governance, which SEBI pushed forth that requirements. Then we had Narayan Murthy Committee. Then we had J.J. Irani Committee, and so on and so forth. Over a period of time, the number of regulations have increased. And what is more important is, after 1956, the first regulation which actually looked at corporate governance more inclusively was the Companies Act in 2013. This is the first time the law and the regulator said that while shareholders are important, corporates must look at larger stakeholder interests. I think this thing has come much later in 2013 compared to when we started in 1956. And that is where I resonate with Japan, which talks about stakeholder, as a part of their core. And this came about only in 2013, where we talk about, as primary board responsibility to look at the stakeholder of the business rather than looking at mere shareholders. And of course, this committees and committees go on, and regulations also go on in our country. The thing is, if you compare regulations in India versus regulation in other parts of the world, I think we are there. Our regulations can match with the best in the world. So our regulator, which is SEBI for listed companies, Securities Board, Exchange Board of India, I think they have been very, very proactive in all this, and therefore, regulatory wise, I think there has been no depth of regulation to ensure that there is good corporate governance, at least in terms of regulation. So this is the first. So all the best practices that we are seeing in other jurisdictions, we also have that as part of our regulation. But if you look at the corporate governance framework per se, although regulation is the driving force, regulation also looks at few aspects of governance, which talks about, the primary driver of corporate governance is the board of directors. And then we also look at other ways to ensure good corporate governance, which includes transparency and accountability, risk management, internal control, internal process and procedures that ensures good governance, good practices, and so on. And of course, within that, there is also an organizational hierarchy which drives good corporate governance in business. So with that in background, with the minimum of regulation, we also have, like I said, the board of directors and rules and regulations related to who can appoint them and so on. We also have others which drive the like the listing regulation, LODR regulation, which drives corporate governance, behavior, and organization. But what I would say is missing in the Indian perspective, which I think is still nascent, is the shareholder activism. Whether you look at institutional shareholders, institutional shareholders have been very, very passive for over a long period of time, whether it is domestic institutional investors, some of whom are the pension funds who are investing in India. They have been usually either siding the management, or they have been very, dormant in terms of resolution and what they are voting, etc. But of late, there is again a regulation which drives and says that you must vote, and you have to take a stand, whether for or against. You must ensure that you vote and take part in this, whatever is coming for voting and so on. So that was one difference we saw, because it is also the nature and structure of corporate ownership. So that's a major change. While banks are generally not very active in terms of investing in shares of companies, there may be certain, if they are lenders, particularly large lenders, also appoint what we call as nominee directors on the board sometimes, and therefore sometimes this representation of bankers on board of companies used to be a practice even in Indian companies. Apart from this, the major area where Indian corporate governance is still at the nascent stage, I would say, we have not picked up, is what we call as market for corporate control. While we have, press and media, institutional investors and others, this market for corporate control is fairly missing in our piece, where, while in US, for example, is very active, which is called hostile takeover, or you have class action suits, for example. So these kinds of interventions are still in the nascent stage. Although the law permits class action suits, still we have to see some more action in that area, similar to what is there in the US and so on. So broadly, this is the governance structure, and therefore, a few insights that I wanted to start with. When you come to the board of directors, so we are very different from Japan. Independent directors, having 1/3 independent directors is mandated for companies. Of course, there are some criteria for that. And if you have chairman and managing director as single position, then you should have more than 50% independent directors and so on, ensuring that board decision making is independent of the management and family. Women director is mandated, and therefore this is one regulation that has brought about phenomenal change in the Indian corporate sector. Initially, when the regulation was mandated, it was very interesting to see who came on board. and they were all family members who came on board. So whether it was the spouse or mother or sister, they were on the board. But subsequently, the regulation changed to say that you must have one women independent directors. So because of this regulation, several companies had to change their stand on who will be on their board. And as early as 2023, so most companies had women independent director. Of course, the fact remains that the pool is still small in the sense others, the kind of women you find on the boards of companies are usually there are a lot of cross holding directorship for women directors because of the small pool or because people are not discovering the other women who are available for independent board positions. In terms of committee, in India, we are also committee driven, which is very typical like in US, which is we have the audit committee, which looks at the accounting, the financial aspect, internal audit, external audit, etc. They oversee all this. Then you have nomination and remuneration committee, maybe including as one, which looks at, succession planning, remuneration of directors, remuneration of key management personnel, appointment of these people, and so on. So that is one of the mandate of the committee's work. Interestingly, CSR committee is also mandated in India, and as we all know, that 2% of profits have to be spent on CSR activities, but by certain companies. And this initially was not, although it was mandated as regulation, it was more a comply or explain kind of CSR that was mandated, which of course subsequently we found that more than 40-50% of companies did not comply, and they had some explanation for this. And therefore the law again, regulation changed to, if you don't spend on CSR, what you should be doing with money, etc. Rules came into place. And there are variety of other committees that are there, which are voluntary committees, is not mandated in India. Major SEBI initiatives, I would say SEBI is one of those proactive regulators. Constantly they are surveilling the markets. I think most of us are seeing now what's happening to the F&O market and the kind of initiatives SEBI has taken to bring about some semblance in this market. And therefore, they are constantly looking at the surveying the market in terms of what anomalies are there and so on. Therefore, variety of rules over a period of time. The number of regulations that come out of our regulator is tremendous. Keeping track of that itself has become a good big job, as our next speaker would also agree. The kind of regulation we studied when I did my company secretary versus what she would have studied would be, at least 4 times what it is. So broadly, these are the regulatory and non-regulatory initiatives that are there. And this is what I mentioned, that in terms of market for corporate control, there are certain elements that are still missing. And the proxy firms, advisory firms, these are recent phenomena. I don't know exactly how many number of proxy firms are there, but we have a few of them which are playing very active role in the recent times. Analyst conference call is also there. But the way she had described in terms of what is prevalent in Japan versus what is prevalent, not so prevalent in India, in terms of Japanese focus, it is foreign shareholder and minority shareholders, whereas we talk about shareholders in general. So we don't distinguish between foreign and minority. We put them all into one bucket of shareholders other than the dominant shareholder. So that is one of the things we do. The shareholder stewardship code, this is very interesting. I thought that in India, most things, even if you have a code, very few companies follow this code. Codes are generally voluntary in nature. And therefore, few companies do follow the code. But predominantly, we have been a regulated economy. So there is a lot of regulation rather than just codes. And the third interesting aspect that I saw in the Japanese way of governance is having an independent dialogue with the firms, with the shareholders and so on, other than the annual general meeting. I don't know whether you refer that as meeting with the analysts or is it meeting with the shareholders. So that difference is there. With analysts, there is a lot of meeting. But with shareholders, other than in the AGM, there is no separate meeting, although the analyst conference call probably could be attended by shareholders. I think broadly, I think these are the similarities and differences. But I would like to stop here because ideally this is the place where she can start looking at the market for corporate control in terms of shareholder activism, what's happening in the Indian context, etc. So, Kripa, I invite you to speak about this. You would like to share your PPT?
Yeah, sure.
Yeah. Before she starts, if there are any questions on by online participants, please feel free to write it on the chat, and we will take it up after Kripa's presentation.
Is the PPT visible?
Yeah, it's visible.
Yes. So firstly, I would like to thank IIM and Professor Padmini for giving SES a chance to, present the Indian industry perspective of corporate governance. I would also like to thank Professor Fukimo and all our participants for joining in today. So to begin with, yes, corporate governance has certainly grown in India from a time where, family-owned businesses used to dominate the corporate sector to a time today where companies are mindful of the proposals that they place before shareholders. And they are very well aware that not everything is going to be accepted on face value. So when they place in proposals, they are careful of the disclosures where they know that if investors don't have clarity, they are going to engage with the company. They are going to engage with external parties like proxy advisory firms. And only when they're clear is when they'll take a call. And I believe that this has been possible not due to any single event this journey has not been of an overnight growth, but rather this happened gradually in India. And as we can see, as Professor Padmini has already covered this, that there have been multiple milestones, multiple events that led to corporate governance to where it is today in India. So I will just quickly jump upon the general reasons why, I believe that there is evolution in corporate governance. One is primarily, in India, there are two major laws that governs companies in India. That is Companies Act and SEBI regulations. While Companies Act is more of a foundational law applicable to all the companies, SEBI regulations are majorly applicable to listed companies and comparatively, SEBI laws will be stricter. The reason is very simple that, when it comes to listed companies, there are public funds involved and the public interest is involved at large. So that is why SEBI comes up with regulations, circulars, wherein the laws are stricter as compared to the Companies Act. So when we try to understand as to what leads to evolution, one major reason is that when your existing laws have outlived their life. And this we can understand that initially we had Companies Act 1956. However, as time passed and there were economic reforms and global investments coming into the country, we realized that the existing law is not meeting the need of the time. And that is when, committees were set up and new laws were introduced, which were formulated with the objective that, they meet the need of that time. And another reason why, there is evolution that happens is when you see failures, when you see scandals, because these scandals tells you that, there are gaps in your present legal provisions. There are loopholes which needs to be fulfilled. And these scandals bring a different form of evolution altogether. For example, there was Satyam scandal and with that scandal, there was one major development in legal provisions where it was mandated that all audit report will mandatorily be required to have an annexure on the internal finance controls of the company. So auditors were then required to comment on whether the internal controls are operating effectively or not. So this was one major development that happened after the Satyam failure. And one another reason would be global inspirations. So when you see good things happening globally, you try to take inspirations or cues from them. But simultaneously, you also have to ensure that that is suitable to your present market as well. As to reckless inspirations won't work, but whenever you see good things happening and it is suitable to your present market environment and you try to learn from them, is also how there could be good evolution. And while we say inspiration, there is also aspiration to be better, to be the best. And that we can see when we see that India was one of the first countries to introduce regulations for proxy advisory firms. Now, this was a measure towards improved governance standards in the country, because when we have proxy advisory firms, they also are accountable and they also are responsible because they know that they are regulated and they also have to be mindful of their actions. So, what I've tried to do is that I've collected some of the cases which will help to understand that how there were gaps in the industry and what was done to address these gaps. So firstly, as I mentioned, there are two laws. So while the first 3 points primarily deals with board appointments. So what happens is, generally, I'll give you a gist. The all board appointments, as Professor Padmini had already highlighted, that there is one committee which is designated with the responsibility to identify good candidates for the board. So general appointments, what happens is, the NRC, the nomination committee, identifies a suitable candidate for the board. Then it goes to the board approves the same, and then ultimately all board appointments has to go through shareholders for approval. Now there is a catch here. What used to happen is that there is a certain time gap between when the board appoints the directors, the board approves the directors, and they pass on to shareholders. Now, what used to happen is that Companies Act comparatively allowed a longer period for these appointments, board appointments, to be approved by shareholders. So what used to happen is that sometimes these directors would sit on the board for a long period of time without being approved by shareholders. And when it could even go up to 12 months or even more than that, up to the next general meeting. So what used to happen is that what if these shareholders don't want the said director? But by the time they take a call, this director must have been sitting on the board for a long period of time. So what SEBI did was they introduced a provision wherein all director appointments on the board had to be approved by next general meeting or within 3 months, whichever is earlier. So this reduced the time gap by the time the shareholders approved these appointments. So this was one such way where SEBI plugged the gap. One another case with regard to board appointment is, what used to happen is that, for example, board proposed a director, right? And this director would ultimately be rejected by shareholders. Now, when shareholders reject the directors, it is not a usual course of action, right? There would be a strong reasoning why shareholders are rejecting the appointment. Now, what used to happen is that if shareholders reject the director, the board could again bring the same person on the board. Now, if the original reasons for which the appointment was rejected, if that is not addressed and this person comes and again sits on the board, then this is in some manner disregarding the board's decision, the shareholders' decision. So what SEBI did was that they introduced a provision wherein all rejected directors, if they want to again sit on the board, they can do so only if they have shareholders' approval in place already. They cannot sit on the board directly with board's approval. They would need shareholders' approval also, and only after that they can sit on the board. So this was one significant development that was brought in by SEBI. One another case is that Companies Act allows 2/3 of the board to be rotated frequently at regular intervals. However, allowed 1/3 of the board strength to sit permanently. Now, while this was allowed by Companies Act, SEBI being stricter due to public interest involved, SEBI considered permanent seats on the board to not be of a good governance measure. Now, the reason being that when you have permanent seats on the board, you don't have fear of being subject to review by shareholders. So you might take your seat for granted. So that is why what was introduced is that whosoever directors who are not subject to regular intervals or regular rotation and subject to shareholders' scrutiny, these directors will be subject to shareholders' approval once in at least 5 years. So this ensures board refreshment, and what also is ensured is that these directors know that their performance will be subject to review by shareholders in a reasonable period of time. Now, moving on to, auditor appointments. So what used to happen in the erstwhile Companies Act is that auditors used to be appointed for every year. But what happened with the new Companies Act 2013 is that a fixed tenure was introduced for all the auditors. Now, why this was introduced is that there was a major reason behind that. When you have auditors for a fixed term on the board, that is for 5 years, the auditor's term is stable and it ensures independence. So auditors do not have the fear of being removed any time, before 5 years, or their term is not uncertain. So they do not have the fear of being removed. But what happened was Companies Act also mentioned that these 5-year term is also subject to annual approval by shareholders, annual ratification by shareholders. So this was understood that this was antithesis of introducing the fixed 5-year tenure, because both the things can't work together. Right. So in 2017, an amendment was introduced wherein this annual ratification was done away with. So this reinforced the original intention behind introducing the fixed 5-year tenure. And now auditors have a stable and fixed tenure of 5 years. Now, we recently came across a case wherein RBI for banks has introduced a 3-year term for auditors. However, there also it is written that this is subject to RBI approval every year. Now, we in our reports are highlighting this problem that these both the things are contrary to each other. On one hand, you want a fixed 3-year tenure for auditors. On the other hand, this is also being subject to RBI approval every year. So that is why we are highlighting this contradiction. And one another problem that this highlighted is that we have multiple regulators in a country, and every regulator has different audit term prescribed. While MCA says 5 years, RBI says 3 years, and IRDAI says 4 years. So, for example, if a bank has a subsidiary which is engaged in, some mutual fund business, and then it has a subsidiary which is engaged in some insurance business, and if this bank wants to appoint a common auditor, then it will be very tough for these banks because there are different terms prescribed by different auditors. So what we're also trying to highlight is there are these gaps. If there is a common uniform provision introduced by all the regulators, then this will bring uniformity and will lead to be a better governance measure. So that is what we have identified for auditor appointments. Moving on to, shareholder rights. So one general principle is that whenever a company wants to raise funds, your existing investors have the first right to participate in the increased ownership of the company. But companies generally refrain from this. What company used to say is that, whenever you want to raise funds from your existing investor, it is termed as rights issue. So when companies refrain from rights issue, they give reasons like it is a long process, time consuming, and what if the existing investors back out? There is a risk of failure, right? There is a risk of undersubscription. So generally, companies refrained from rights issue. But this was also somewhere against the principle of your existing investors having the first right to participate. So what SEBI did just very recently, just 3 days back, is that they have introduced reforms for rights issue. So earlier, what used to take 300 days for the entire rights issue to be completed, now it will be close to 25 days. The reason why this has become possible is that initially the draft offer letter had to be filed with SEBI, but now you can do that only by filing the same with stock exchanges. So the entire process will be much, much faster, and now companies will be able to do rights issue easily, and this will uphold one of the shareholders' principles of them having the first right to participate in the increasing ownership. And when it comes to risk of failure of undersubscription, that is also resolved by SEBI, where they've written that if there is undersubscription, then promoters and company itself also can sell these undersubscribed portions to any specific investors. This will also ensure that firstly, the existing investors have the right to participate. And then if that is not successful, and if that is not wanted by the existing investors, then the other category investors can always pitch in.
Yeah, Kripa,
Yeah.
interest of time, can I request you to move towards the activism that's there in the last few years in India?
Yeah, sure.
Yeah. So all these, I mean, she's bridged the gap very nicely between, general governance, what's been the case in India versus what is, what is the regulator thinking and what are the changes that have happened over the last so many years. So thanks, Kripa, for that. But I would, we are quite interested in knowing how activism has improved in India over the last few years.
Yes, ma'am. I will try to go into that slide. Yeah. So what happens is every year, once our season gets over, once a proxy advisory time gets over, we try to, introspect and look as to what has happened in the previous years and, what is happening in the present year. And this is what, the data shows as to how what are the times when we recommended against, what are the times when the institutional investors defeated the resolutions, and when it was aligned as to we said no and investors also said no. So, there are some key areas where investors are specifically interested now. And these key areas are where investors are sensitive. They expect transparent disclosures from company. And if they're not convinced, they even don't refrain from, saying no to these resolutions. So, this is a graph where it shows, and you'll see that there is a gap, there is a reduction in the number of resolutions which were recommended against by us between 22 and 23. No, there is a very interesting fact behind this. So what used to happen is that, we used to say no to adoption of financial statements whenever the subsidiary financials were not put up on website. But we adopted a new approach in 2023, where we asked the companies to put up these subsidiary financials on the website before issuing the report. So companies used to have this intimation priorly, and they used to put up these. So this, explains that half of the times it is not that the companies are actually doing something wrong, but it is just a gap of transparency. They do have the data, but they just miss out on informing the shareholders. And that is why there is a reduction between 22 and 23, where companies used to, rectify this thing. And by the time we issued the report, the problem was already resolved. So this is a graph where it shows, how it is going up. Especially it can be seen in the yellow line where it is showing, how many resolutions were defeated by the shareholders. From 50 to 77 in 23, 77 times shareholders rejected the proposals that were placed by the company. And the adjacent graph, tells you that what are the primary areas where investors are extremely sensitive. And you can see that the major portion is occupied by RPT proposals, where investors are extremely sensitive because RPTs in itself are very sensitive transactions. And, there are ESOPs as well. While you see ESOP 6% here, our latest year shows that, ESOPs are also extremely sensitive resolutions where investors are extremely critical when taking a call. So, I've tried to collect some cases wherein, we saw that the investors rejected the resolution. Now, I will just try to, take up some examples and try to explain as to what are the reasons why investors said no to these proposals. So one such case that I'll firstly touch upon is Dixon Technologies, which you see in the last row of the table, where what happened is that they had proposed an ESOP scheme. And what happened was ESOP schemes are basically where you reward your employees and these benefits are linked to your share-based benefits. Now, there is a specific ESOP regulation that is introduced by SEBI, and SEBI asks companies to make a fixed set of disclosures in their explanatory statement. So what happens is that what Dixon did is that they proposed an ESOP proposal, and whatsoever mandatory set of disclosures that were mandated by law, most of the disclosures were left up to NRC discretion. For example, you have to disclose a vesting period, exercise period, and this is supposed to be specific. But what company did is that it linked it and left it up to the NRC discretion. What happened is ultimately the disclosures were not convincing to the shareholders and they rejected the scheme. Then what the company did is that it tried to engage with the company, it tried to engage with the shareholders, it tried to engage with the proxy advisory companies and brought in a proposal again where all the disclosures where all the concerns were addressed and there were specific disclosures that were made and the resolution ultimately got approved by the shareholders. So this was one such case. Another case I would like to talk about is Siemens. Siemens is it's a prominent company in India, and they had proposed a related party transactions. However, what they did is that they proposed a valuation which didn't really convince the investors. The investors didn't have much clarity as to what is the basis upon which the valuation was ultimately proposed. And the investors rejected the resolution, and this transaction was ultimately called off. And this, really shows that, investors are not accepting things as it is. If they expect clear, transparent disclosures, then companies do understand that they have to propose complete proposals. Another case is when it comes to, I can touch upon remuneration also. So if you see Paris Defense, remuneration was proposed to an executive director. Now, what happens is remuneration proposals usually have a fixed element and a variable element. Now, variable element is at times linked to your profits. Now, what happens is your profits are uncertain. Usually, executive directors are proposed for a 5-year term. And what happens is your profits in 5 years won't be static. It will be dynamic. So when you say that I'll pay my director 5% or 10%, what happens is your profits are going to be uncertain. So if investors do not have clarity as to what will be the potential payout, is when they face some discomfort in approving the resolutions. And that is why a remuneration proposal was rejected by shareholders for Paris Defense, where the institutional investors majorly stated that we want an absolute cap on the potential variable pay over the next few years. One another case was for Aarti Industries, where commission was proposed for non-executive directors. But what was done is that there was no validity period of the proposal. It was uncertain, and it could also be, it can also stay valid for an uncertain period of 5 years, 10 years, whatsoever. So shareholders rejected the proposal, saying that, we want a specific tenure for the validity period of the approval. And that resolution was also rejected by the shareholders. Moving on to some other recent cases is when, you see Eicher Motors. Eicher Motors, Mr. Siddharth Lal was one of the key prominent persons of the company. In somewhere around 2021, his proposal was proposed for remuneration. And what happened is his directorship was also proposed in the same meeting, and in the same meeting, his remuneration proposal was also proposed. But the shareholders were not convinced of the remuneration terms. They thought it was excessive considering the performance of the company. And what they did was they said yes to the directorship proposal, but they rejected the remuneration proposal. And that is where, it also shows that investors are active today, and investors are very also mindful of their actions. They're very clear that they're okay with the director. What they're not okay is with the remuneration terms. And another case that, I would touch upon is again of delisting by Vedanta, where, delisting was proposed, and they gave an exit price to the outgoing investors, and investors felt that the price was not fair, and they felt like they deserved more. The value of the shares had to be more, and that is why they rejected the proposal, and the delisting was called off. And when you see today, the prices are actually much higher than what was offered by the company. So, we can see that this is a combination of different companies. You see not only small companies, but even big, large-sized companies also face rejection by shareholders when, shareholders are not convinced with the information given. So,
Yeah, thanks, Kripa. I had some questions. So
Yeah.
we will, in the interest of time, actually, there are a lot of questions which even I want to ask. So we
Yeah.
will come this side so that we can address.
Sure. Yeah.
Thanks, Kripa, for that. Yeah. Yeah, before we open it to the audience, I myself have 1 or 2 questions for the speakers, and then we'll open it to the audience.
Yeah.
It is very interesting to see that shareholder activism has gone up, particularly with firms like yours and the others, InGovern and other firms that are looking at this. But I have a fundamental question for you, which is in terms of certain proposals that are there. Given that the promoter ownership is very high in most of these companies, and the number of shareholders who attend the meeting and also vote, that number may not be that high, then how do we resolve this issue of improving the shareholder activism? Now, of course, people are becoming aware, but in some sense, we cannot really defeat the proposal, but we can only dissent. So that's a good start. So what do you think with your experience, where it is going, where it's heading?
Yeah, in this last 3 years itself, there was a time when, there was hardly any calls from investors. When companies used to place proposals, we used to hardly see that, investors used to most of the times accept what the companies used to be saying. Or as you mentioned, that, investors would either refrain from voting, abstain from voting, or else, they would just accept what the company used to say on face value. But, you won't believe that now that we get calls from investors, they are extremely vigilant. When they try to understand the proposals, they don't accept things that we say on face value, neither they do accept things that companies say on face value. What happens is these institutional investors, they have their own teams, they have their own analysts, and they also have their own policies. So we are just, more of an educationist, where we try to educate them as to, we find these problems. And what they do is that they try to understand that whether they want to align with our decision or the company's decision.
Okay.
So certainly there has been growth, and that is what we've observed.
Thanks, Kripa. I would now pose the same question to Professor Takeda. In terms of the reaction in the market, I mean, your research is also focusing on the reaction of a proposal in the market. So what has been your quick summary of that? Although you presented, how does market react to these proposals?
Yeah, concerning market reaction to shareholder proposals, the reactions are basically positive to announcements of proposal, but negative to rejection. So that's why the investors, I think react favorably to shareholder the proposal. Because usually shareholders' proposal includes increase of shareholder returns. So that's why. Yeah.
Thank you. So, do you all also track, Kripa, question to you, do you track the market reaction when you, talk about these proposals?
Yes, we do have a practice where, we try to see how, what is the percentage of dissent that is given by
No, not like
investors.
that. What I meant is, does the market, share price, for example, how does that react when you come with a positive or, favorable, unfavorable shareholder proposal and so on? Have you seen some correlation between the market reaction to what you all propose?
Yeah, so basically, since, we are majorly concerned with governance aspect of the actions, we generally do not track the market reaction.
You're not tracking that when, probably that is left to the researchers like us.
Correct.
Okay. What I will do now is open the questions for the audience. So we have Mr. Sarkar also wanting to ask one question.
Yeah, sure.
Thank you. This is a question for Professor Takeda. Thank you very much for your speech. The question I have is, why did Japan feel obliged to change its corporate governance system? We always knew that Japanese companies emphasized long-term sustainable growth rather than profitability as compared to the American companies. And your system of capitalism, the father of Japanese capitalism, Eiichi Shibusawa, he also had a broader understanding of public interest, which the companies followed. And in some research that we did at the center, I read that 40% of global companies which are more than 100 years old, which have survived, are Japanese. And a study which looked into these companies, a Korean study came out with a large number of characteristics of these companies, the way they have sustained for such a long period. The one aspect that was missing was profitability. So there seems to be something in your corporate DNA which allows you to go through thick and thin periods of war, periods of depression. And I see that even if you look at, you mentioned the bubble, maybe that's a trigger. But 20 years of deflation, loss of innovation, etc., none of your big companies have gone bust. You continued with very low unemployment figures, minimal social unrest. Companies that we have studied like NEC, from hardcore manufacturing companies, they have suddenly turned in the space of 10, 15 years to a completely different business model based on services, even though the employee strength is 100,000. So there's something that is there in your DNA. Why are you implanting an American system which may or may not be suitable for your system, which is a tried and proven system. So I'm trying to understand. I understand probably one reason is that you want to bring in foreign investment. Is that the main reason, or do you feel that there's something really wrong with the system that appears to have held you in good stead over this long period?
That's a very brilliant question. As we observe American companies that have a very short lifespan, Indian companies are somewhat moderate, but this is interesting study. So your view on that?
Thank you for the insightful question. Yeah, I agree that the trigger was the collapse of the bubble, and after that, the power of the dominance of banks has been declined, and also corporate needed a lot of restructuring. So the banks monitoring and insurance laws have been declined. So that's why there is a need to cover the gap. So the government and the industry, so the institutional investors, may be able to replace the role of main banks in the past. So that's why, two codes require institutional investors to be engaged in the long term with companies. So I think the shareholder activism, the current very dramatic shareholder activism, maybe a transitional one, but some of the activists' proposals, sometimes they include hints for the companies to improve their operations, especially many Japanese companies are regarded as being poor at the selling their unprofitable segments. So maybe sometimes the activists tried to push companies to restructuring more. But so that's why currently current situation maybe just a transitional one, I think so, because long-term aspects are emphasized actually, and the institutional investors and companies both are learning. Thank you.
It's also because your foreign investment is very high, 40%. That is also driving this.
No, he's saying the change in corporate governance, is it because the foreign investors are very high now and therefore they expect a change in the governance code? Would that be a reason for the change? Maybe.
Both domestic and foreign investors very active in Japanese market, and but some of them play a very important role in improving companies. In particular, Value Act. I think Hong Kong hedge fund helped the restructuring of Olympus, and also some other hedge funds will help the Japanese companies to improve their operations. So not all hedge funds are bad, we think.
But the hedge funds.
I have one question for you, ma'am. We talked about but it was in your presentation. So there's a lot of new rules which has been come up regarding board composition, institution and stuff, and these are all at the process levels. But how do you think the board, the board members, is actually at what stage is it, and is it coming up to the shareholders meet itself?
Yeah, so this is a very interesting question in terms of what is board doing for its evaluation. In fact, we were discussing this and it came up as one of the interesting areas for research. How does board evaluate, or how do board members evaluate? I would say some companies have a very robust system, board evaluation done by a third party external vendor who does this evaluation. I call them vendors. But otherwise, most companies have peer review. And it's supposed to be published in the report in terms of, do they have a board evaluation process? What's been any, is there a negative connotation, etc., etc. So I would say it's a mixed bag. While there are companies that have very, very professional evaluation, but there are a lot of other companies that stop at peer evaluation. And there are pluses and minuses for both. I mean, people of stature in the board, and having a third party evaluation of them, maybe they are a little uncomfortable of that. But at the same time, if you look at peer evaluation, it's like our students peer evaluation for their presentations. Nobody wants to give a low score. If they are true, they would give a proper score, but everybody wants to be in the good books of the other. So maybe it's not really a robust system in that sense. So I think it's a mixed bag in India. We are still evolving in terms of evaluation process. That's where it stands today. And yeah, Kripa, I had one question for you.
Yeah, sure.
Yeah, which is, is there a presence of activist investors? Like in Japan,
Yeah.
it's very strong.
Yeah.
So, what about India? Does it exist in India? Are there activist investors? Not the proxy advisory firm, but do we have activist investors?
I don't think so. We don't really come across a lot of it. But we come across cases where companies like shareholders do gather, and when they feel like they are not okay with a proposal, they try to come together and raise their voice. So we recently saw it with regard to a merger between a bank and a subsidiary, where investors have queries, and they are trying to come together and put up questions to regulators and to other court authorities as well, where they're trying to go to the shareholder. So there is no asset specific investors. But if case comes up where investors feel like they're not okay with something, then they do try and raise their voices and come together. That is what we've seen. We also saw this in case of Z versus Invesco, where Z refused to call a meeting that Invesco wanted to hold, and they even went up to High Court, where they said that the company is refusing, and High Court ultimately supported the investors and asked the company to convene the meeting. So yes, there is activism, but yeah, not asset specific. It's more of a case specific situation.
We also track what has been the result of these voting patterns, for example, in terms of what kind of advisory you have given and how many shareholders voted for and against. Of course, dissent you are tracking.
Yeah.
Do you see any kind of relationship between your advisory and the voting that's happened patterns?
Yes. And, we do that every year. And I won't say that, today, investors are not blindly following our recommendations. That is for sure, because the alignment is extremely little. Firstly, the rejection itself is extremely little. But what we see aligns is the portion of dissent by institutional investors. That certainly has grown over the years. So what happens is most of the proposals in India gets passed because, there is major promoter ownership or controlling ownership. So you don't see dissent much. But when you see institutional investors voting pattern, that very closely aligns with what proxy advisors recommend. And that also is moderate.
Okay. Yeah, I had another question, Professor Takeda, which is, in terms of in Japan, one of your research says that board also recommends, activists on the board. So what's been the reaction, for example, when directors are recommended to the board, directors recommend activists to the board? What's been your research experience on this? I mean, this is very specific to Japan.
Yeah.
In India, I've not come across a case where the board recommends activist shareholders on the board of the companies. So it's very unique to your context.
Yeah, very unique, but yeah, the number is increasing recent years. However, we have only very limited cases. We actually, to present, we have only 9 cases.
9 cases.
Nine cases, and six experienced improvement of operating performance, but 3 experience decline of ROA and ROE, and they chose delisting agent. Yes.
How do you define activism?
Huh.
That's at the shareholder level.
What is meant by an activist shareholder? Activist. You know, who is an activist? As per your research definition. Yeah.
Yeah. Actually, so in recent years, more and more institutional investors and individual investors also tend to act like activists. So the situation has been changing. However, in the past, the institutional investors, individuals are not so active. So, and so some distinct hedge funds are regarded as activists.
Hedge funds.
Yeah, previously. But in recent years, we are more ordinary investors, tended to be act like activists. So the definition may change in the future, but previously, only hedge funds we focus.
But is there a percentage of shares that they own? These individual shareholders to become activists? Do they have to own 5% of the shares or something like that? Or it doesn't matter.
Mm-hmm. Yes. Actually, so the compared to the US, the shareholder proposals are easier in Japan. Yes, the barriers are very low compared to the US and European countries. So this is because previously the shareholder proposals were very rare. So that's why barriers were very low. But in current situation, so the regulators, I think are thinking of changing the regulation, because sometimes individual investors, especially sometimes propose very absurd proposals. So so that's why situation has been changing too in this area.
I have a question to Professor Takeda.
Yeah.
Japan, in principle, are not favoring takeover of companies, Japanese companies by outsiders. Am I right, or it is not so? Taking over of any Japanese companies by outsiders are not liked by the Japanese in general. Is it correct?
Previously, so I think, but currently some of the very big companies were purchased by foreign companies.
Some of the large companies are now purchased by foreign companies.
Examples include Sharp.
Sharp. Okay. That is the one recent one, very exception. But generally, I have been seeing or hearing that there is not much of interest in getting a majority shareholding in a Japanese company.
Mm-hmm. Yes, situation has been changing, but basically, they do not like. They don't like. I think.
I think the Stewardship Code, or maybe the law, says that these proposals cannot be summarily rejected. A committee has to look into it. Some due diligence has to be done when such an effort attempt is made. I think there is something in the code.
Yes, So in the case of US, so the court dissolution is very common, but probably as you know, so in Japan, such a way of resolution is not still common. Usually internal coordination is more prevalent. So that's why, the situation has been changing. Code. Oh, sorry.
Part of the code.
Stewardship Code.
Stewardship Code. I'm sorry. So I misunderstood actually. So.
Stewardship Code manual on how they should act on the.
Actually, they were not mandatory. So.
They are mandatory. One is not mandatory. Any questions by the viewers? Anything? One second. Any questions online? Participants, please Viewers, you can put it on the chat if there are any questions. Yeah, we'll wait for the questions. Over to you, sir. Your question?
This to Kripa.
Yeah.
Her slide, she mentioned about shareholder activisms and the kind of performing
Yeah.
actions being rejected by the shareholders. But I personally thought if you have a very strong outside board of directors or independent directors coming, it should have been shot down right at the board itself. It shouldn't have even come to the shareholders meeting. Them are in that range as to why it even went beyond. If you have a very well-performing independent shareholder, independent board members, because it's their job to do that in the first instance.
Correct.
Yeah,
So-
Kripa, you can take that in particular to, for example, the RPT example that you were talking about.
Yeah.
So, what could have been the challenges that the audit committee accepted that proposal, but it came to the, meeting to get rejected or whatever?
Yeah. So mostly, this happens because firstly, the independent directors on the board must have not seen a problem with that. Because, because in most of the cases, you have majority independent directors on the board. SEBI requires you to have majority independence on the board if there's an executive leadership on the board. So usually, if independent directors do have a problem, it does come out in some form or the other. So the first reason why it comes to shareholders is that independent directors mostly don't see a problem with that. But of lately this is changing because we see of lately that when independent directors are not okay with what is happening internally, then they do have started resigning from the board as well, where they give their resignation letter that is put up on the stock exchanges, where they clearly write that we are not okay with these things and we don't want to continue on the board. Now obviously these are very extreme measures and you rarely see them, but mostly that is what the expectation is, not for this to come to this extreme case, but rather that is also our objective, that this doesn't have to come to this end. Rather it gets discussed internally only, where independent directors try to place these things before the board and this gets resolved in the board stage itself. But mostly why it doesn't happen is that presently independent directors don't see problem in these things, and that is why it ultimately goes through shareholders.
Yeah, I
And
think. Yeah, continue, Kripa.
yeah, and that is, and mostly when it comes to other cases, when it comes to disclosures and everything, so that is also happens because of sometimes the interpretation gaps. Now, the company, law is subject to multiple interpretations. So sometimes board has a different interpretation, we have different interpretation, shareholders also do have. So sometimes bridging a gap between all the different interpretations is also a task. So that is also one of the reasons why, there are differing views between different counterparts.
Yeah, I think this has deeper research that's there, in the back end. One is, of course, who's on the board. So
Yeah.
that makes a lot of difference. The board diversity, the kind of people who are on the board and how decisions happen there. Second, there is also a lot of research on CEO personality versus the other members, how they interact. I mean, there's a lot of research on this. For example, if you look at WeWorks, how this bank kept funding WeWorks in spite of its losses, in spite of its negative performance, etc. So that's where the CEO's own personality and other things takes precedence over logic sometimes. Sometimes there is also a herd mentality. I mean, these are all not my viewpoint, in the sense these are all well-researched areas of board performance, what happens in the board, and so on. And therefore, there could be sometimes herd mentality, if you are not very clear about certain resolutions that are coming up, and you hope that certain others have done their job who are, saying okay to the proposal. So there are a variety of dynamics that happen in the board. And therefore, that could be one of the reasons why it was not seen. And, you need a different lens to see this kind of issues and so on. So, and of course, what finally also matters is the, dominant shareholder. Their views are always stronger than the independent shareholders' view. And like she said, this is one of the problems we are seeing in the last 2-3 years, that many independent directors have resigned from boards of companies stating certain issues. And earlier they used to say personal reasons and resign, but now they cannot resign just saying personal reason. They have to state what is that reason. Am I right, Krupa?
Yeah, sure, ma'am. Sure. Yeah.
So that's the trend that we are observing.
Yeah, and one of the participants were asking for the presentation. Yes, I would share it with ma'am and you would get it.
Yeah, whoever is registered, we can share it with them.
Yeah.
It was a very useful presentation for us.
Thank you. Thank you. ma'am.
Yeah, there are two more questions.
Yeah, my question is related to the analyst conference calls. Many a times what we have noticed is minority shareholders, they don't get much information on what's happening in the company. So do the listed companies mandatorily have to conduct these analyst conference call or investor conference calls at regular intervals? Is it mandated by law?
Okay, question to you, Krupa, is one is this analyst conference call which happens periodically.
Correct.
So his question is, are these mandatory by law? Second, do individual investors, are they allowed to attend these? Is it just analyst or, can investors also log into the call? But to answer your third part of the question, these calls finally are there on the company website. They have to disclose, the transcript, etc. Of that. In most good companies I've seen, at least the transcripts are available of these calls. Yeah.
So presently LODR deals with this requirement and there is no mandatory requirement to conduct calls. However, law says that if you do conduct the call, it is mandatory for you to put up the written transcripts on the website, also put up the audio video recordings of the website. And if you have shared an investor presentation with the investors, that is also supposed to be put up on the website. Now, this is a mandatory requirement, but only if you conduct the same. And you will find these on the company websites also and stock exchange websites also. So that is where the law is presently. But yeah, ideally what law should do is that there should be at least 4 mandatory earnings call so that every time there are quarterly earnings that are being discussed. So you have, those call transcripts for all the investors. When it comes to retail investors, yes, anybody who wants to participate in the calls, they can. There are no obstructions for any investors. But mostly we see only institutional investors. That is something that we're yet to see that individual investors also participate. That is rarely that we can see.
Okay, last question for you, Professor. Are these conference calls mandated in Japan? Is it voluntary? Do companies have analyst conference calls? Do they have?
Yeah, I think it's voluntary, but in Japanese case, we have like a fair disclosure law.
Fair disclosure rules.
Yes.
Yeah, we also have that.
Oh, okay. So I think many companies have a conference. Yeah, voluntarily. Yes.
So fair disclosure rules are also there in India because before any meeting, there are certain price sensitive information that have to be disclosed. If you're going to take up that as part of the board agenda or, once it is approved in the board meeting or at the annual general meeting within, some of these have to be intimated to the stock exchange within as short time as 15 minutes, 15 minutes, 30 minutes and so on. So, in a lighter vein, I used to remember when their emails were not there. So we used to keep a person ready there at the stock exchange. And, the moment this is announced, we'll call him and say, okay, now you file these statements, etc. But of course, now you can always upload and technology has enabled all these kinds of things. Yeah. Any other questions? Yeah, over to you.
You did hint, Padmini, that India has very strong regulations but very weak implementation or enforcement. So, how is this experience in terms of Japan?
Yeah.
Especially, what are the repercussions of not following? Because you have some codes and companies follow the codes. We have regulations, but companies don't follow the regulations, but still get away. What has been your experience?
Yeah. Usually, I think Japan do not tend to have a strong regulation compared to India, but we have a very strong peer pressure.
We have discussed this.
Yeah, in the case of COVID-19, government and industry asked people to be very careful. We have a very strong peer pressure. And so I think, yeah, that's why even two codes are not mandatory. There are many Japanese companies try to change their structure, corporate governance structure.
I hope one day India moves to that level, that we don't need regulation, but by mere peer pressure, you give the best practices and say, here is your standard, here is your benchmark, and just through peer pressure, we comply with those good practices. I think we will wait for that day. I think we are far behind that, the peer pressure. It works in some industries though, particularly disclosure, etc. What companies disclose, transparency in terms of what they report in annual report, and so on. That is very, very there in terms of disclosure in certain industry. For example, IT, your software industry, and mainly I would say because they are dealing with foreign clients and so on. So there it works. Particularly if you look at their reports, they are very transparent there. But all others, we are yet to be there. Yeah. Any last question? I think in the interest of time. Online, anybody is asking any question? Any idea?
No.
Okay. So I think I thank, of course, let's start with online. I thank Kripa for filling in at a very, very short notice, and she did an excellent job. Thanks, Kripa, for sharing those insights with all our viewers. And Professor Takeda, thank you for your insights from Japan. I learned a lot today from both, the way Japanese corporate governance work and the way, proxy advisory firm work. So, I mean, there's a lot of improvement that we have to make, and there are a lot of things we can learn from Japanese code and so on. Thank you so much for taking time out and making our presentation. Thank you.
Thank you.
Please have a big hand. Okay. You want the mic or you want the gift?
So, no, I just wanted to thank, of course, Kripa for joining online, as well as, of course, Professor Takeda and Professor Srinivasan. Very great work. And we have learned, as you said, all of us have benefited a lot from this seminar. Thank you very much. And a small token of appreciation to Professor Takeda. May I request the two chairpersons to come. We will send you a small gift by post.
So a small gift from our center side, from the Center for Corporate Governance.